But very few candle chart users apply any type of volume analysis to their charts. And if you don't believe me, go look at the books for sale in your bookstore. And open the candle charts. I think Nissan, I never know how to pronounce his name, Steve Nissan. Okay. He talks about volume. Right? He talks about volume. Steve Bigelow talks about volume. There are other people, and I don't want to mention the people that don't do, because I don't think they're doing as good a job as the other guys. You need to understand some volume stuff. You need to relate it to volume. But they're not relating it to Wyckoff volume. The people talking about volume there. They're relating it just to volume in general. Okay? Many candlestick experts don't use volume analysis, or they use it in a limited fashion. And where we're going now with this is a different area. We're going to specifically apply Wyckoff volume analysis to the candle chart pattern. And it's totally different. So if you've heard a presentation with somebody, maybe Bigelow or Neeson, that mentioned volume, I'm talking a different kind of volume analysis than they are. Totally different. And it has different meanings in the charts that we're going to look at. It has different meanings when we look at these three bar formations, three types of bar formations that we're going to look at. Shooting stars, we're going to look at dojis, and we're going to look at hammers. That's all we're going to spend our time on. And I'm going to show you chart after chart after chart to show you what these things look like, the little nuances around it. And the reason I'm really going to do all this is so that you can start to visualize it. You can go home with it. You can say, I see it. I get it. It's something easy to get, instead of fogging you over with 100 different formations that you're going to have to watch the tape again before you ever had one chance of applying it anywhere. Okay, so we've got a doji on this chart. Got a doji right here. Open and the close are very close to each other. They're not exact, or we would have that little tick on both sides. If we look over in the top left-hand corner, over here, the open is 41.19, the close is 41.17, so 2 cents. What's 2 cents between friends? Yeah, it's a doji. Close enough. Fuzzy logic, if you want to call it that. It's a doji. So what else do you notice here, though? Got a long wick, and I heard selling climax, but I don't see a selling climax. Yep, low volume. What else? Say again? I heard something. Sorry? Well, we're in a consolidation, but what is that bar doing compared to the previous bar? It's a down bar. It's a test. That's it. If we forgot about candlestick analysis and just looked at Wyckoff analysis, that's a down bar, close lower than the previous bar with low volume. That's a test. But now it's a doji test. So they have this so-called indecision that these experts are talking about. But I don't see any indecision on that bar. I don't see any. What I see is that market was tested from the open. It went down, and there was no volume. There was no sellers, so they came right back up and continued up after that. I don't see indecision there. I don't see where that's not signaling to you that you need to start looking at that, because there's no buyers. There's no sellers down there now, especially because of this. Because the open and the close are in the same area. We took all this range down, but we ended up in the same place, and when we did that, there's nobody down there to sell. Where's the sellers? If we take that down and there's people interested in selling, we should see that increase, and then we're going to see this drop after. Because this is low, and it comes back up here, we expect this to go up. But here's the best thing that I like about test bars in general, and I'm going to talk about doji tests, and I'm going to talk about hammer tests today. But tests, as we talked this morning, these things have the expectation. Now, we are expecting them to react immediately. When you trade off of a test bar, it's very easy where you're going to place your stop. It's very simple. If that low is violated, you made the wrong decision. Cut and dry. That cannot be violated if it's going to be a successful test. I don't just mean the next bar. I mean, as you go up and then come down again, you've got more weakness coming in, right? And that gets taken out, even if it's 6 bars over here, you got a problem. So that's a great place to put your initial stop loss. And we're going to get more into stop losses and things in our presentation later on this afternoon around support and resistance. But This is stuff that's great to show you as it's on the screen so you can visualize it, you can take it in your mind, you can write it down. Tests are the best place for a low-risk trade. Not going to call them the highest probability if you're just taking it off of a test by itself, but certainly you have a low-risk trade. Because if we look at this, the close was 41.17, the low was 40.98. You got 19 cents. It's 19-cent risk on a $41 stock. It's peanuts, right? It's peanuts. And we expect, because it tested, and it tested the right way, the Wyckoff way, we expect that test to react right now. The market should react to that test. So if you're a day trader, you can take, and I don't day trade stocks, I just don't get it, but people do, right? And there's nothing wrong with day trading stocks, it's just not my cup of tea. But if you're day trading stocks and you see this is a great thing. My God, I mean, it went from 41.19 to 42, it went 80 cents, 42.10, 90 cents. As a day trader, that's a tremendous trade. That's a tremendous trade, and this is a 15-minute chart. Right? So 90 cents in 3 bars in 45 minutes. And it did that because of that test. That's what a doji test looks like. Here's another one. Now, what is this one different than the other one, though? What's different about this? This is a little nuance, so I'm going to make you guys work this session.
Higher flows. Closed higher than the previous close. Not on much volume.
Somebody said something about a climax.
Comes after.
That's what I wanted you to see. Do you see the velocity of both the price and the volume on this bar that precedes the doji test? This is taking out the low of that on light volume. It's testing to see where are the sellers. Is there anybody down there that's interested in selling? No. It's obvious. This is a 30-minute chart on the S&P minis. You went from about 13, well, that closed at 1375. You were up at 97.50 before that day ended. For you E-mini traders, that's a hell of a trade. That's, close up shop, I'm going home, I'm done for the day. It's over with. I mean, the day's probably almost done anyway, but, you went up from 75 to, actually it's almost 1,400. So you went up 25 points. But it was set up by 2 bars. Now, remember what we learned this morning? Right here. Selling climax, we can see it because there's a velocity change here, an increase in velocity of this price bar down. We actually get another kind of tell, if you will, market tell, because look at where the close is on that bar. It's closing off the low, so we know that we have to have some buying coming in to make that thing, with all that volume and this velocity come in, to close back up here, something's got to be pushing it back up as it got rammed down. And the only thing that can do that is professional money. What we don't know just on that bar is, should I buy right now? Is that a place I want to buy right now? No, I can't buy right now because I don't know what the next bar is going to do. It might do that again with even higher volume, and that's what we got to guard against. But right here, I'm telling you guys that trade E-minis, this happens all the time, that you're going to have these little doji tests. It's going to slightly take this out because that's what people, and I don't know if this is a fact right now, but there could be another low, so it's a double low, double bottom, and the E-minis love to take out things by one tick and get all those resting orders that are ready to go short again and keep them going. But this tells us there's nobody interested in selling. And that set it up. And that is how we start using this stuff in real life. And that's different than anybody else is telling you on looking at volume and looking at this stuff, because we're looking at it in the Wyckoff way. We're looking for climaxes. We're looking for these things that are showing us proof that there is some buying coming in. And now we've got the test coming in. It's a quick test, though. But you got to remember we're on a 30-minute chart. If this is a weekly chart, you're probably not going to see this. A weekly chart's going to take a little longer. Yes, Mary?
A simple question. So if the test bar was high volume, you would not consider going long there. It had taken out the previous low on how much less volume do you want, and if it's more volume, you really don't want it.
You're making me put in rules again. That I don't like, and I understand the question, and I do appreciate it. I don't like rules. But let me tell you what maybe you're after. If you had higher volume there, one thing I will tell you is look at this first. we closed, I hate looking through my glass, I can't read up close anymore, I'm getting too old, but we closed here at 1375, the low of the bar is at 72 for a 3.25 point stop. You could take the view and say, I don't care, I'll take the roll of the dice, okay? Because as an E-mini trader during the day, you can do that. 3.25 points is not a lot of points. So I can take a 3.25 point stop and say, I know that the test shouldn't be taken out. The low of that bar should not be taken out. Had I had higher volume, I would be less inclined to do that, yes, because it means that there may be some more supply down there. But conversely, it may mean that when we went down there, and this is where, if this is a 30-minute chart, I'm going to break it down to a 5-minute chart or a 3-minute chart. I'm going to see where that volume came in. Did it come down right at the bottom to push it up, or did that volume come on top to push it down? That's where I'm going to rip this bar apart and start looking at it piece by piece. We always need to do that when we have any questions. All we do is take that bar and break it down. 30-minute bar, I'll break it into 6 bars. 5 minutes. If I still don't know, I'll break it into 10 bars, 3 minutes. If I still don't know, I'll go down to 1 minute with 30 bars. You're going to find the answer somewhere. The answer is in the bar chart or the candle chart. It's just knowing enough to look for it. But long story short, that kind of thing in an E-mini, I like that kind of trade. Doji tests in E-minis, Doji tests in 4X on intraday time frames work very, very well. Because the nice thing about it, what does it have to do to test? At least you got to take a low. You got to take that low out of the previous bar. You have to come down here, and when you come down here and it just jacks right back up, that's a market tell. I mean, I'm a poker player too, and I watch people with market tells are playing with your ring and covering your nose and your mouth when you're bluffing, and it's a market tell. You can't see the people you're trading against, but it's the same thing because it went down and now it came back up, and it's going to be very rare, I think, that you're going to see that. And it's not going to react to it. But there are bars that it won't react to. But the great thing is, when you're wrong, you know where your stop is. You know exactly where. There's no nebulous nature to this part at all of trading. Is doji test, 1 tick below. If you want to give it a little more than 1 tick, 2 ticks below. But that test bottom low cannot be taken out. That negates the whole test. Now you got a failed test. Now you know you got weakness. You should start looking the other way, down. Those are stop and reverse positions. Right? Because if I take that low out, it's probably not going to take it out by 1 tick again and have the thing go up after it was already taken out by 1 tick just before. And then that 1 tick that it took out the previous bar by turned into a doji test. And that is not usually going to happen. Another one. Okay, now that one, if we look at a straight test, we're closed in the middle of the bar. The close is lower than the previous bar. The low is lower than the previous low. Where did the volume go? This is a 5-minute chart of the E-mini. And you'll see this over and over. I'm not going to tell you to see it every day, but this type of formation you're going to see a lot in E-minis, intraday time frames. They just show up. I can't sit up here and tell you that everyone works. Don't take that as a message. But the message here, let's say this one didn't work. I'm going to just drill this point home again further. The close is 1401. The low is 1450. I got less than a point stop. What do you got to lose, really? I mean, you don't want to throw everything I talked about this morning away. You still want to see some signs of strength coming in the market. But when you've got a doji test and it's a half point between the close and the low of that bar, I mean, if you give it 3/4 of a point, so you give it 2 ticks to get out by, you don't have a lot of risk. And the great thing about tests is they have to react right away. So it's a quick trade. You're going to be right or you're going to be wrong, and you're going to be in or you're going to be out. And if you're in, you're going to be trailing your stops. I'm going to show you how to do that in the next seminar. You need to trail your stops and then ride that. Remember, we talked about everybody cutting their losses short. Well, no, we want to ride the thing because that could be that 25-point move that just happened on a 5-minute bar off a doji test. It could be. We saw the 30-minute bar with a doji test go 25 points higher during that same trading session. That's the beauty of these doji tests. It's a doji for a reason, and there's no indecision about it. I would argue with the greatest expert on candle chart analysis in the world. I don't know who he is, or she, But that's nothing about indecision to me. That's clear. It's clear as a bell. There's nobody down there selling. There isn't. I mean, they came down, they went up, and then came down again, and went up again, and came down again. But we're on a 5-minute chart. You're not always just going to have moves that go like that. But if you look at 1401 is the close, we went up to a high of about, it looks like about 1404.50. So 3.5 points in 30 minutes. A lot of people would be real happy to have just a day of 3.5 points, especially if you're trading multiple contracts. Doji test again. There it is again. I mean, it's showing up all the time. And this is McDonald's, so the hamburgers, on a daily. And it looks like if we saw more of the background, it looks like we might have been in an accumulation phase. Let me see what kind of price change we had. Went from about 55.50 to 61.50, so that's about 10% move in a matter of, it looks like, about maybe 12 days. But what I'm trying to get across on these is when you see this doji, and that closes lower than the previous bar, and it's closing next to the open, you're taking out the low of the previous bar and there's no volume down there. What is that telling you psychologically about the marketplace right now? You got a pretty clear idea that there aren't any sellers down there. And the great thing about it is we know that from a couple different reasons. We know it because of the low volume, but we also know it because it went down like that or went up like this and down. We don't care right now. And then it came back up. When it went down, we didn't see any sellers. We didn't see increased volumes. We made a new little low for the last, probably week and a half of trading there. That's a big market tell. Mary?
Is the bar that followed that, which was another doji, because that was even lighter volume, that further confirmed the lightness of the selling?
No, that would be a confusing bar for most people. It's an up bar. It's on lower volume. A lot of people say, that looks like a no demand doji to me. Ooh, how do you deal with that? Well, if you had no sellers down here, you've had sideways action here, you're going up, but you're not taking out the test low, you don't care. I don't care. That test low is golden. That's the golden rule. On these doji tests, hammer tests, the low of that test cannot be broken. If the low of that test is broken, it's a failed test, the market's weak, and it's probably going to drop. And you want to be on the short side, not the long side. It's the simplest rule in trading that I can come up with in anything with Wyckoff or candle volume analysis. That test is the easiest thing to trade. Ideally, though, don't forget, and this is where the nuances come in, don't forget this morning, we don't just want to look for a test anywhere. Tests can happen anywhere on a chart. Dojis can happen anywhere on a chart. Ideally, we want to see an accumulation area that had a selling climax before it, and I'm talking for the bigger moves now. You got the selling climax behind you. You had some other testing. You could have tests go on that aren't doji tests. Doji tests, when you see them, and I'll let you look at enough charts to form your own opinion. Right? I don't want to cloud your judgment right now. I like doji tests. Doji tests to me tell me something. That when you don't look at volume and you don't understand volume, you just see dojis, you can say, my God, I don't know what they're doing down there. But it's telling you clearly that there aren't any sellers there right now. And that next bar, although it can be confusing to most people, it didn't violate the golden rule. Golden rule, you cannot take the low of this test bar out because now it's a failed test and the market's going to fall most of the time. You certainly don't want to stay long if you establish a long at that test. Once that test is taken out, the low of that, you're either out or you stop and reverse. It is that easy. Failed doji test, there it is. That's exactly what the danger of this is. This is why it's better to find a bottom right here. We drop, right, just like the other charts. Now, we can't see anything before us, so we could assume this is just a basing pattern again, just sideways movement. And all of a sudden we drop down, and when we drop down, we've got a big reduction in volume, and we open near the top of the range of the bar, go all the way down, and come all the way back up. What's a market tell there, though, that you can see on that chart? that you might not want to take that trade right now. Can you see a market tell? I'm going to help you. Right here. There is an increase in velocity on price and volume, and it's closing off the highs back in the middle of the bar. That would denote to us that we do have some selling going on. So if we've got selling in the background, do we want to be buying soon after that? No. But we can get fooled. Could be spur of the moment thing. This is a daily chart. You're probably not going to feel the pressure of a live intraday environment when you're looking at daily charts. You got time to look and read these things. But let's say it was a 5-minute bar. Hey, you might have missed it. But the great thing about it is at this price, 29.28 close, 28.71 low, so it's about, what, 50 cents? A little bit more than 50 cents on a $27 stock. That's, I mean, it's, if you got leverage, that can be something. But the great thing is, you see what I mean by stop and reverse? When that thing's violated, it's a tradable move. It's something that you can pretty much rely on the other way now. So I'm going to talk more about stop and reverse areas in the next session that we're going to do this afternoon, but that's a place to stop and reverse. And I know that stopping and reversing for a lot of people in retail land it's the scariest thing you're ever going to do. Not only are you admitting that you're wrong with your initial move, now you're taking a position that you just got burned on, right? You lost money on, now you're going to take the other side of it. But I'll tell you what, if you're doing your analysis right and it doesn't do what it's supposed to do, it's going to move, and you can trade it. And stop and reverse orders are great places with these test bars. Very good, safe thing to do, because when you take a test out, you are going to expect further weakness in the market. Other side of the spectrum, doji still, doji up bars though, doji no demands. Same thing we talked about this morning with no demands, right? No demands we want to happen on the top of a chart, preferably. We'd like to have weakness in the background if we can, to further confirm that. Now this is a weekly chart of Disney. And what we see here is we've got in this area, there's that really big volume bar again. It's going up. And what's this right there? If you're just talking Wyckoff, forget about candle volume analysis right now. You're looking at Wyckoff. Yeah, it's got an up bar and the volume's gone, right? So here we come up. There's the volume associated with it. Look at what happened to the velocity of the price. Did it increase or decrease? It decreased. And in decreasing, we also lost the velocity of the volume. After we had, just before that, increasing velocity and price and volume. So it's like this ebb and flow. And then we've got this doji bar right after it. It's no demand. We have to have a higher close than the previous bar. So this doji bar closes higher than its previous close. But look at it. Then where did the velocity go on this? It's gone. There isn't any. That's an inside bar. Right? Inside bar, I mean that entire range of that bar is inside the previous bar's range. So it's going nowhere. After we saw this big move up, relatively speaking, in the last few bars, it looked like this thing was going to just take off. But what are we kind of doing here? Look, when you look at the structure of the market, look at this. You take these old tops, I can't draw too well, but we're getting up and getting into a double topping area. So, and when we're getting into the double topping area, I'm going to talk about this when we talk about support and resistance. This is key to what we're looking for as traders. We expect that there's going to be some supply there because we're up around an old range top, and all of a sudden you can see the market reacting to it. The bars react to it. The participants in the market are reacting. They're telling you a story because you look at the volume and you look at the velocity of price and volume, and it's gone. Around an area where we expect supply to hit the market. That's a tell. Excellent. Now this doesn't work the opposite way though. No demands don't have the same things where you can say if I take out the top of a no demand bar, then you stop and reverse. Don't do that. Do not do that. But you can see that we just poked our head a little bit higher in the next bar. Just a little bit higher. but then it came down and it came down again. And on a weekly chart, I can relate this to you like if you owned this stock, say it was in your portfolio and you saw this do this, and you rotate your stocks in your portfolio, you say, well, it's time to rotate out of this one. This is a weekly chart, so this isn't noise. There's no noise in this chart because of the length of time that we're looking at it from. On a weekly chart, it's a long-term view. You reduce really most of the market noise from the chart because of the duration of the time you're looking at. But we look at that, we closed at 32.57, and it looks like we went down to, what, 29 in the end. And then we came back up and made a new high, right, higher high. And what I'm trying to get across here is these things have ebb and flows to them. And what you may do here is different from what the next person may do. A weekly chart, if you own this stock, you might want to rotate out of it and go on to another stock that looks more promising, that looks like maybe you're getting a doji test on. And you want the money from this part of your portfolio into a stock that you're expecting it to do something now, not to go the opposite way from you. If you're a day trader, this can set up your directional bias for 3 weeks, right? You got 3 weeks of directional bias that happen. I only know that in hindsight, to be fair, but I certainly have my next opening day, I'm going to start looking for short trades. If I'm a day trader on Walt Disney, I don't really want to buy anything on Walt Disney. I'll wait till I get market setups that let me sell, and that market setup's going to come pretty quick that next week because you're going to hit the double top. That looks like it's almost exact. I don't have any way of measuring this because it's a PowerPoint slide, but that looks like it's almost exactly a double top. And that's what you're going to expect. You're going to go on your smaller time frames. Your smaller time frames are going to show the weakness in the bars, and then that sets up your day trade for Walt Disney, if that's what you do. Another doji, no demand. This one, we don't really have a lot of volume cues, if you will. There's not a whole lot that we can, I don't think, see from this chart. We got a shooting star that we haven't talked about yet, but we got a shooting star over here that starts to show weakness. But really, the only thing you got a no demand bar here, which we're talking about. But other than that, and I'm sorry, we got the no demand doji, and then we're followed by another no demand. But there's not a lot going on, but it gives us on a monthly time frame. This is Intel monthly. This is pretty powerful. I mean, when you look at the move that came from it, I wouldn't have traded it at this time. There's nothing to tell you that you need to trade it. But it certainly tells you to beware. If you were thinking of buying Intel and you saw this formation, you're crazy, right? You're going to lose money most of the time if those are the kind of decisions you make. But because it lets us filter these stocks out of our selection process. If nothing else, we can say, well, I got the long bias like we talked about this morning, that most retail traders only go long. And when you go long, you've got one direction to go, and that's it. You've got one choice to make. It's either in or out. You know, I'm going long or I'm out. It's a lot easier to make money shorting, in my personal opinion. But most people don't do it. They don't understand it. It's a personal bias for most people, I guess. But you need to get over. Is there anybody that doesn't short in here? I don't mean to put you on the spot. You got one? And you may have your own personal reasons not to do it, but I would encourage you to look at trying to sell. Look at ways to learn more about shorting. Because the great thing about shorting things is because of gravity, if you will, and gravity really has nothing to do with it, it's just a concept, the market falls faster than it rises. So if we can take advantage of shorts, we're going to make money quicker when we're right than trying to buy something and then waiting for this thing to drag and drag and drag up. So shorting, you make money faster, you get reactions faster, and you also know when you're wrong faster. So it's a good thing to be both a long and a short player when we're doing this. Another doji, no demand. Now we've got the nice background coming up. This is this is my stock. I did went and get my paper. I went to get my paper. This, Continental Airlines. Remember me talking about Continental Airlines? We're up around $50 almost up there, $50 a share. Here's the money section of USA Today. So this is more for the tape so that you guys can see this from the tape, but the date on this is Friday, June 6th. So when you guys watch this 4 years from now, June 6th, Continental joins trend of reductions. Cuts include 3,000 jobs and nearly 100 flights a day. Oh my God, that's horrible. Investors Business Daily, Friday, June 6, 2008. Continental cuts jobs capacity. The number 4 U.S. airline became the latest carrier to make major cuts amid soaring fuel prices. Well, they are soaring, right? But this stock, when this news is coming out, look at the right edge of your chart. What do you see? Look at it. Well, look right here. Who's playing the game right now? Retail traders don't want anything to do with this. You went from $50 down to $14. I mean, could you imagine you're still holding that as a retail trader? You lost almost all your money. And now the pain's here, and now professionals want it. I can show you professionals want it just by looking at that. The velocity is really increasing from the way it started down. We're closing off the low. And this is too early to tell, right? Because this is a monthly bar, I think. It's a monthly bar, so this month just got started. You can't read anything into this yet. But certainly what we know from the start of this month is it didn't go lower again. That's something. Months early, it's June 7th as we do this. But right now, that momentum didn't keep carrying it down. We can see somebody's coming in with all that volume. We saw it on American Airlines on an earlier chart. Watch your airline stocks. If you look at stocks at all, watch your airline stocks.